Picture two traders running the exact same strategy. Same setups, same win rate, same edge on paper. One of them risks a small, steady slice of their account on every trade. The other sizes up whenever a setup feels strong, sometimes 2 or 3 times as large. A year later, the small, steady trader has quietly compounded their account upward. The one who sized up for the good ones has less money than they started with. Doesn't that sound almost impossible on paper? Same strategy, same edge, wildly different outcome. How is that possible if the size of the trade is just a number you choose? It's tempting to assume bigger size simply means bigger profit, scaled up in a straight line. Risk twice as much, make twice as much, all else being equal. But all else is never actually equal, is it? The moment you make a trade bigger, you don't just change what's written on the position ticket, you change the psychological conditions you'll be making every decision from for as long as that trade is open. And that's the part almost nobody accounts for when they decide how big is big enough. Here's the reframe worth sitting with. Position size isn't just a lever on your profit and loss, it's a lever on your own judgment. Doesn't it seem strange that something this easy to adjust could carry that much psychological weight? Make a trade big enough, and it doesn't just multiply your potential reward, it multiplies fear, urgency, and every bias that was already sitting quietly in the background, waiting for a reason to take over. The trade doesn't just get bigger, you get worse at trading it exactly when you can least afford to. Welcome back to Trading Psychology Animated. Today we're going to unpack exactly why trading smaller so often outperforms trading bigger, and what that means for how you should actually be sizing your own trades. Neuroscientist John Coates spent years studying this directly, on a real trading floor rather than in a lab, wiring up traders to track their hormone levels across a live trading day. What could hormones possibly have to do with your trading edge? What he found was a feedback loop most traders have never heard of. Sound familiar so far? A winning trade raises testosterone. Elevated testosterone increases confidence and appetite for risk. Increased risk-taking leads to bigger positions. Bigger positions, if they also win, raise testosterone further still. Round and round it goes, each cycle nudging risk-taking a little higher until the position sizes involved have nothing to do with the original strategy and everything to do with a hormonal spiral quietly running the show. Doesn't it change how you'd read a winning streak knowing your own biology might be the one pushing you to size up next, not your edge? Coates also tracked the mirror image, cortisol, the stress hormone, climbing under sustained uncertainty and loss. And here's the part that matters for size specifically. Both of these effects scale with what's at stake. A small trade barely nudges either hormone. A large one can send them both into ranges that actively impair judgment, the same way extreme stress narrows a person's thinking in any high-pressure moment. Why would anyone want to be making trading decisions from inside that state? Small size isn't a beginner's training wheel you eventually graduate out of. It's what keeps your own physiology inside the range where clear judgment is even possible in the first place. If this is changing how you think about your own position sizing, this is a good point to hit like and subscribe, because the next piece of research explains something even stranger about how you're supposed to learn from your own trades in the first place. There's a second researcher whose work explains exactly that. Antoine Bechara, working alongside colleagues studying decision-making under uncertainty, ran what's become one of the most cited experiments in the field, the Iowa gambling task. Participants choose cards from 4 decks, some quietly rigged to produce small, steady gains, others rigged to look exciting but bleed the player out over time. Which deck would you have picked first? The remarkable finding wasn't that people eventually learned to avoid the bad decks, it's that their bodies started flagging the dangerous decks through a measurable stress response in the skin before the person could consciously explain why. Bechara called these early warning signals somatic markers, a kind of learned gut feeling built up through repeated, survivable exposure to outcomes. Isn't it strange that your body can learn a pattern before your conscious mind catches up to it? That gut-level learning system is exactly what small position sizing protects. Somatic markers only calibrate properly when the stakes on any single trial are survivable enough to let you keep playing, keep noticing, keep building the pattern across hundreds of reps. Size a position big enough, and a single outcome carries so much emotional weight that it stops functioning as one data point among many. It becomes an event. And events don't train your gut feeling the way repetition does. They overwhelm it. So what actually happens to a trader who consistently trades too big to stay emotionally regulated? Their somatic markers never get the chance to calibrate properly, which means the intuition they're relying on to just know when a setup is off was never built accurately to begin with. There's a third piece of research that explains something even stranger about what happens to the traders who feel the most in control of their own outcomes. Mark Fenton O'Creevy studied professional traders directly at several investment banks, measuring something specific: how much control each trader believed they had over outcomes that were, statistically, driven substantially by chance. The traders who scored highest on this illusion of control, the ones most convinced their actions, their checking, their fine-tuning were steering the outcome, were not the top performers. They were on average the worst performing traders in the study. Doesn't that run backwards from what you'd expect? Shouldn't more engagement, more conviction, more active management produce better results, not worse? Here's why it doesn't. A trader firmly convinced they're in control of an outcome intervenes more. They check the position more often. They adjust the stop when it feels wrong. They average down because surely with this much attention on it, they can steer it back. Does that sound like control, or does it just feel like control? And a bigger position feeds this illusion directly, because more money on the line makes the outcome feel like it matters more, which makes it feel like it deserves more active steering, even though the market itself has no idea how large your position is or how closely you're watching it. Size doesn't just raise the stakes, it raises your belief that you personally can manage the stakes through sheer attention, which is precisely the belief Fenton O'Creevy's data says to distrust the most. Now, here's the twist that ties all three pieces of research together. The instinct to trade bigger usually shows up disguised as evidence of skill, never as the warning sign it actually is. A trader who's been right several times in a row doesn't think my hormones are running a feedback loop. They think I've earned the right to size up. A trader whose gut is screaming that a setup is dangerous doesn't think my somatic markers never calibrated properly because I've always traded too big to learn from feedback. They think this one just feels different. A trader intervening constantly on an oversized position doesn't think I'm in the grip of an illusion of control. They think I'm finally paying the attention this trade deserves. Every single mechanism that makes trading big more dangerous is specifically the kind of mechanism that feels, from the inside, like confidence and competence. Isn't that exactly what makes it so hard to correct on your own in the moment without already knowing to look for it? This same pattern shows up well outside of trading, in a place where the stakes are measured in far more than money. Airline pilots don't learn how to handle an engine failure for the first time in a real cockpit at 30,000 feet with 200 passengers behind them. They learn it in a flight simulator, specifically because the simulator keeps the stakes small enough that judgment can actually function while the skill is being built. Only once that judgment has been calibrated at low stakes does the size of what's genuinely on the line increase, one careful step at a time, never all at once. Nobody looks at that training pathway and calls it overly cautious. Everyone recognizes it as the only way to build reliable judgment under pressure. Why should trading be any different just because the cockpit is a screen and the passengers are your own future decisions? So, what does all of this actually mean for how you size your own trades? It means the goal was never to eventually graduate from small size into large size once you feel ready, the way a beginner outgrows training wheels. Coates' hormone loops, Bashara's somatic markers, and Fenton O'Creevy's illusion of control don't check your account balance or your years of experience before they activate. They respond to how much is genuinely at stake on this specific trade right now, regardless of how skilled you've become. A trader with 10 years of experience sizing far too big is exposed to the exact same feedback loop as a trader with 10 days of experience doing the same thing. Skill changes your edge, it does not change your biology. The practical fix isn't complicated even if it runs against instinct. Keep your position size fixed to a small, consistent fraction of your account, decided in advance, completely detached from how confident any individual setup happens to feel. Because confidence is precisely the signal Fentano-Creevy's research says not to trust with more size. Let your sample size grow before your position size does, because Bashar's research says accurate intuition needs hundreds of survivable reps to calibrate, not a handful of dramatic ones. And treat any winning streak as a moment to watch your own hormones more closely, not less, because Coates's research says that's exactly when the pull toward bigger size feels most justified and is least trustworthy. Trading small isn't the cautious option you settle for until you're good enough to trade big. It's the structural condition that lets your judgment, your intuition, and your discipline actually function the way they're supposed to. Picture those same two traders again, a year further on. The one still sizing small isn't leaving money on the table. They're the only one whose psychology is still intact by the time it matters. Hit like and subscribe for more of this. And if this changed how you think about your own position sizing, tell us in the comments what size finally felt big enough to start clouding your judgment. Thanks for watching. See you in the next video.